Okay, ladies and gentlemen, good morning. Happy Thursday, everybody. It's a snow day, sort of, kind of. Some of you might have been spending the morning shoveling. I know I was, and as exciting as that is, it's nice to see some familiar faces here virtually via Zoom. So, ladies and gentlemen, welcome to a session with a pretty long title, I might add, called Tax Efficient Shareholder Compensation, the Fundamentals. The idea behind the session is to review some fundamental concepts that are relevant when you are deciding to pay something out of a corporation to a shareholder. And we're going to look at some relatively basic things today, hence the term fundamentals. And depending on how the session goes, if there's an appetite for something a little bit more advanced, perhaps that's something we can do in the future. As we go through our session here today, ladies and gentlemen, if you don't mind, at some point, I might ask you a question or two. And if you don't mind, if you can, please participate. For that purpose, we will use the chat. I suspect that most of you folks are familiar with how the chat works. I'm just going to post a quick message in the chat. Welcome to the chat. So at some point, if you have a comment or a question, or if I might ask you maybe a question of some sort, please use the chat. This is a good way for everyone to kind of communicate virtually because it's one kind of central place for communication. Okay. With that quick intro, and people are still coming in. Amazing. We're up to 75. Let's get going. Okay, so just a quick disclaimer, ladies and gentlemen. These materials were prepared for educational purposes. All right. Naturally, anytime you have any kind of real life situation, you probably would want to have a qualified professional review that situation. All of you, ladies and gentlemen, are qualified professionals. So just keep that in mind. I made every effort to make sure that my materials are accurate, free of errors and the like, but don't just send my presentation to a client and say, hey, do this. You might want to review the facts of that before you do that, just an FYI. Okay, so some of you, ladies and gentlemen, may have been faced with this particular question from a client on maybe an annual basis, all right? How should a shareholder pay themselves out of a corporation? Let's say I have a corporation. Let's say there's money in the corporation. Let's say the shareholder wants to spend that money. The question becomes, how do we pay that out? Ideally, we would want to minimize the tax impact associated with making some kind of payment. And I think the timing of this particular topic is probably a good one. Here we are at the end of January. As I'm sure you are aware, January, February, people's year ends start coming in. You might have to start thinking about issuing T4s, T5s, and some kind of compensation decisions will certainly factor into that. So there's the $1 million question. How should I pay myself? The answer, which is a typical answer in most cases, is it depends. Okay. On what? On a variety of different things, which in some cases might be present in a client situation. In other cases, they may not be present. Hence the term it depends. So first of all, how much money does your shareholder need, right? Are we talking about a large sum or a small sum? What tax bracket is that going to put themselves in? What tax bracket is the owner currently in? What tax rate will they be paying on any additional compensation? That's going to be relevant. What kind of corporate income is being earned in the corporation to begin with? Is it active business income? Is it eligible for the small business deduction or not? Those things will have an impact on what form of compensation to pay out. What so-called tax attributes might exist inside the corporation that we're dealing with? So for example, is there some kind of balance in there? I'm not going to name anything yet, that may perhaps be paid out tax-free, or is there some kind of balance that can be paid out in some kind of tax-efficient manner? If so, then maybe that will dictate how you structure compensation. Is it possible to maybe split income with somebody else in the family, maybe a spouse, maybe perhaps kids, if there's a family trust in the picture or something like that? As I'm sure your folks are familiar with, there's a concept called TOSI, which you may have to consider in that context. But there's various exceptions from TOSI that might be possible as well. So there's a few things you need to consider. And really, in my humble opinion, at least, there's really no one size fits all answer. It is largely dependent on the facts and circumstances of any particular case. Also, does your owner, the person who's going to be receiving this compensation, do they care about things that are not income tax related? For example, do they care about the ability to make RSP contributions? Maybe they have a financial advisor who keeps telling them, make your RSP contributions, maximize your RSP. Well, if that's the case, as you probably know, in order to make an RSP contribution, a person needs to have something called earned income in order to be able to have RSP contribution room. Salaries, ladies and gentlemen, create earned income. Bonuses create earned income. Dividends do not, for instance. So if an RSP is something that your owner wants to be able to do, maybe salaries are the way to go. Bonuses are the way to go, perhaps not a dividend. Do they care about being able to receive CPP benefits at retirement? I don't know about you, but I've sort of heard different opinions from different people on this. Some people say, yes, I want to make sure, I want the government to pay me what they owe me. And other people say, I don't want to rely on the government, quite frankly. I want to do my own thing. So if a person says, yeah, I care about CPP, again, you need to be able to have something called pensionable earnings, and thus requiring a certain amount of salary or bonus per year to at least hit the maximum. If a person doesn't care about that, then maybe salary is not that critical, and maybe you can pay out a different form of compensation. Some families may have existing childcare expenses, all right, myself included. Those child care expenses are expensive, ladies and gentlemen. They cost thousands of dollars, even after this latest government thing that we have going on. Well, in order to be able to deduct child care expenses, generally speaking, you need the lower income spouse in the family to once again have something called earned income. And earned income is driven by largely salaries and bonuses, not by dividends. So if that's a consideration in the family, maybe a certain amount of salary would be a prudent thing, because that would allow you to deduct some level of childcare expenses at least. If a person who's an owner of a company in the future is thinking of maybe selling the business, and perhaps they're thinking, can we qualify for the capital gains exemption? Well, there's a concept in Canadian tax called CNIL. CNIL stands for cumulative net investment loss. And if an individual has CNIL, it reduces the amount of the capital gains exemption that they can essentially claim. And dividends reduce CNIL. Salaries do not. So if you have an owner manager who's thinking down the road of selling their business and they have a CNIL balance, which is something you can check to represent a client, then maybe pay them some dividends over the next number of years, eliminate that CNIL balance, and then have them sell their company and be able to claim the capital gains exemption in full. Does a client want to not bother with withholdings or perhaps late filing penalties for something like a T4? Well, if that's the case, then maybe do a dividend, because a dividend does not require withholdings, number one. Number two, a T5 can be filed late at a fairly small penalty, whereas a T4, if you're filing it late and the withholdings are late, there's larger penalties there. Okay, liability issues. There's been a number of court cases, particularly in recent years, where a corporation that owed the CRA some kind of money, be it GST, HST, income tax, payroll tax, whatever, paid a dividend to their shareholder. And there's a rule in the Income Tax Act, without getting too technical, that basically says that if a corporation pays a dividend while it owes the government money, the government can go after the dividend recipient for the liability. This is true if a dividend is paid. It is not true if a salary is paid, because a salary is considered to be a fair value, let's call it exchange of money for labor, whereas the dividend is a distribution that's optional by the corporation. So if there's liability issues in the company, don't pay dividends. You may create liability issues for the owner manager, for example. Qualifying for a mortgage. I don't know if you folks have had this experience. I unfortunately had this experience not too long ago. If you're trying to qualify for a mortgage, most general sort of big banks will say, show us a T4 slip. And if you say, well, I have a dividend, they're like, oh, we don't know what that is. Okay, we don't know what a T5 slip is. We don't understand that you're a business owner. We only recognize T4s. Well, if that's the situation you're in, maybe pay yourself salaries, bonuses, not dividends. Lastly, in Ontario, we have something called employer health tax, EHT. For a company that has a large payroll, payroll over a certain threshold is subject to an additional tax called EHT. So if you want to avoid that, then maybe pay a dividend. And for folks who are receiving old age security payments, once your income is above a certain amount, you start getting your benefits clawed back. So folks, notice these are some additional, let's call them maybe not exactly tax cost items per se, but things that are also relevant in the context of an owner manager, which a person may care about or may not care about. You may have a person with childcare expenses and RSPs, you may not. And so depending on if that exists or not, that could also impact your decision as to what to pay. Okay, folks, here's our general sort of quick agenda for what we're going to be covering today. We're scheduled to go for about an hour and a half. Hopefully it's not going to take any more than that. Maybe we'll finish a little bit earlier, we'll see. Okay, first and foremost, we'll take a look at certain things called tax attributes. A corporation may have certain attributes in it that are relevant for compensation. And if you know what those are, you can structure compensation in a certain way to take advantage of them, maybe in a tax efficient manner or maybe in a completely tax-free manner. So we'll take a quick look at what those are. We'll do a quick review of what the tax rates look like in Ontario for individuals and corporations on different types of income. This is relevant once again when you're trying to compensate somebody. We'll take a look at the impact of integration in Ontario. What is integration? You probably have heard me talk about integration before, and we'll focus on what are the implications of integration specifically for compensation planning or for year-end planning. And lastly, for your pleasure, we have a case study that was prepared to kind of illustrate potentially a client that you might see with some specific things that it's doing and how might you structure compensation in that situation. Okay, so here we go. First of all, what exactly do we refer to when we say the word tax attribute? A tax attribute is some kind of balance, maybe a carryover balance, maybe something that it keeps track of, that the company can either distribute or recover as part of compensation, as part of paying a dividend, perhaps. And the bottom line is it may result in less tax paid overall. So if you know what balances a company has, if you use them, you may create more tax efficient compensation for your owner manager. Okay, some tax attributes can be distributed completely tax-free to your shareholder. And generally speaking, you probably would want to pay these out first if you're thinking about how to compensate an owner manager. For example, a private company will have something called a capital dividend account, commonly referred to as CDA. A corporation may receive certain things that are not subject to tax. A common example would be 50% of a capital gain. Half of it is taxable, the other half is not. Life insurance proceeds could create CDA, things of that nature. So that can be paid out completely tax-free, probably one of the best forms of compensation. You might have a situation where an individual owns shares of a corporation that have significant paid-up capital, aka PUC. PUC measures the amount of funds that the corporation originally received when the shares were issued. PUC can be recovered tax-free by the shareholder through either something called a return of capital or through a redemption of shares, where a portion of the redemption proceeds is recovered tax-free. The remaining portion might be creating a dividend. And lastly, a very simple example, if there's amounts that are owing to a shareholder. So if you look at a balance sheet and there's a due to shareholder on the balance sheet, well, that means the shareholder either lent money to the company for some reason, or perhaps paid for some kind of expenses on behalf of the corporation. And the company can pay the shareholder back on a completely tax-free basis. So these things, if they exist in some kind of situation, you probably would want to distribute first. Why? Because they're tax-free, completely tax-free. There's no tax collected by the CRA when these things are paid out. Okay, second, there's other attributes that could result in what I describe as a tax efficient distribution. Specifically, something called refundable dividend tax on hand, otherwise known as RDTOH. Everybody's favorite tax attribute, I'm sure. RDTOH keeps track of refundable portion of tax that a CC pays on investment income. So if you have a CCPC and it has investment income, things like interest, things like dividends, rental income, for example, taxable capital gains. All of that is considered to be investment income. And the way that it is taxed initially at a pretty high rate, but the tax that is paid to the CRA, part of it is refundable. And we keep track of it in this thing called RDTOH. Also, on Canadian dividends specifically, we have a special kind of tax called Part 4 tax. And Part 4 tax is fully refundable as well. So if a corporation receives dividends from another Canadian corporation, they might be paying Part 4 tax. If they do, it'll be tracked in some kind of RDTOH account. The company can get that back, Okay, now, since 2019, so for the last 3 or 4 years now, we've had the pleasure, and I use the term pleasure quite loosely in this context, to be dealing with two kinds of RDTOH. We have something called eligible RDTOH, and we have something called non-eligible RDTOH. Okay, now, why is this relevant? To recover one or the other, there is a certain kind of dividend that you need to pay. So if a company has, let's say, eligible RDTOH, but not the non-eligible kind, or vice versa, this will impact what kind of dividend you may decide to pay out of the corporation in order to get a refund of that balance. Eligible RDTOH can be recovered through the payment of eligible dividends or non-eligible dividends. Now, generally speaking, you would probably want to pay out eligible dividends if you can, because those are subject to a lower rate of tax. However, non-eligible RDTOH can only be recovered through the payment of non-eligible dividends. If you have eligible dividends and there's non-eligible RDTOH, unfortunately, a refund of that will not be triggered. How does a company recover RDTOH? It's simply based on the following formula. It's the amount of a dividend that you actually pay multiplied by the refund rate of 38.33%. So a quick sort of practical tip is that if you ever see a corporation and there's RDTOH in the corporation, take the balance of the RDTOH and divide it by 0.3833. That'll tell you how much of a dividend you need to pay in order to get a full refund of that. So corporations that have RDTOH probably make sense to pay some kind of dividend because the company will get the RDTOH back. There'll be a tax recovery in the corporation in exchange for personal taxes paid by the individual on the dividend. Okay, now for a CCPC, what determines if it can pay eligible dividends or not? And it is something called the GRIP balance in a CCPC. A CCPC tracks something called GRIP. It's called the General Rate Income Pool. It's computed on Schedule 53. Generally speaking, GRIP is corporate income that was subject to tax at the general corporate rate, not the small business rate, but the general corporate rate. And since the corporation paid more tax on this income, it can be paid out as a special kind of dividend, aka eligible dividend, which will then create less personal taxes in the hands of the shareholder. So a company that has GRIP, I would argue that's a good tax attribute because you can then pay a better dividend, eligible dividend, which will attract less tax in the hands of the owner manager that receives it. So eligible dividends are taxed at a lower rate. Now, if a company has exhausted all the attributes that it had, paid them all out, or has no attributes to begin with, well, my only other two options really are this. Either pay a non-eligible dividend because I don't have any GRIP, or I can pay additional salary or bonus. And the implication of one versus the other is a little bit different. There's a different implication to the individual. There's also a slight difference in what the corporation does when it pays one or the other out. So first of all, if I'm paying out a non-eligible dividend, it's a higher tax rate than eligible dividends. If I don't have any RDTOH, there's no refund to me anymore. And the corporation still pays tax on its income because dividends are paid out of after-tax earnings. If I'm paying out a salary or an additional bonus, instead, the tax impact is a little bit different. The salary is deductible to the corporation. So the corporation, as a result, will pay less corporate tax if you're paying out a salary or a bonus to your owner manager. It effectively shifts the income out of the corporation and into the hands of the owner manager. And that could be perhaps advantageous depending on what kind of income the corporation is earning to begin with. Okay, so folks, let's quickly take a quick look at what do our tax rates look like in Ontario, both from a personal point of view and from a corporate point of view, because this will be relevant if you're deciding to pay out, dividends, salaries, things of that nature. Okay, if we're looking at an individual who's in the highest marginal tax bracket, and this is in Ontario, and folks, these rates have not changed since the year 2020. So they've been the same in 2020, 2021, 2022. And as far as I understand, the government has not proposed any changes moving forward, at least as of yet. So we'll likely see these exact same rates in 2023. An individual who's in the highest marginal tax bracket in Ontario, if they receive quote unquote regular income, such as a salary or a bonus, will pay tax at 53.53%, pretty high rate of tax. If you're paying out dividends, it depends on what kind of dividends they're receiving. So eligible dividends are taxable at a rate of 39.34, non-eligible dividends at about 47, right? So notice between these three, naturally eligible dividends mean you're paying the least amount of personal tax. However, the corporation that's paying you that dividend already paid some corporate tax to begin with. So that has to be factored in as well. And lastly, if an individual has a capital gain, it's only 50% subject to tax. And therefore, the effective rate on the entire capital gain, if you look at it that way, is basically half the regular rate, which is 26.77. This is the reason why sometimes we look at planning called a capital gain strip. If a corporation has a lot of retained earnings, a lot of cash, or a lot of other assets that can be taken out, there's a special reorganization you can do called the capital gain strip. Why? Because you end up paying tax at this rate as opposed to one of these rates. I think you guys have heard about a capital gain strip from a previous presentation, as far as I understand. Okay, now corporate tax rates. This is what they look like in Ontario once again, and they haven't changed since 2020. And again, there's currently no plan to increase or decrease them either. Here's the federal component, here's the Ontario component, and here's the combined rate. So if I have a company that gets the small business deduction, I'm paying a pretty low rate of tax, total tax of about 12.2% in Ontario. If I have a company that has no small business deduction, I'm paying the regular rate of tax. In Ontario, it's 26.5. In Ontario, we have a unique situation. In certain circumstances, if you have a CCPC that has a lot of investment income, there's a difference in rules for federal purposes and provincial purposes. Federally, you're going to lose the small business deduction or start getting a reduced business limit. However, provincially, you still get the full small business deduction because the Ontario government doesn't care about how much investment income you have. So you may have a bit of an interesting situation here for income where the small business deduction is lost federally, but not provincially. You get a weird tax rate between the two, which creates perhaps an opportunity for some planning. Aggregate investment income, things like interest, rentals, royalties, taxable capital gains, subject to tax at a very high initial rate, 50.17%. However, a good chunk of that, about 30%, is refundable, goes into non-eligible RDTH. And last but not least, dividends are subject to Part 4 tax if we're dealing with regular portfolio dividends, dividends that are received from a public corporation. The tax on those dividends will be calculated at a rate of 38.33. So this is what the rates look like in Ontario in the current year. They haven't changed since 2020. They're likely not to change in 2023 either. Okay, folks, I'm going to take a quick look at something called integration. For those of you who've attended our annual tax update, I typically talk about integration there. So this is probably similar information, but we'll look at it now from the point of view of compensation. So if you earn a certain kind of income, what might make sense from a compensation point of view? Integration is an idea in Canadian tax that basically says this. A person can earn income in a couple different ways. They can earn income directly as a sole proprietor, as an employee, as an investor, or they can incorporate a company, and the company, the corporation, will earn that same income. If I'm earning income directly, there's one level of tax that is collected by the CRA, personal tax. That's it. However, if I have a corporation and my corporation earns income instead, I have two levels of tax. There's corporate tax on the income paid by the corporation, and eventually there'll be personal tax on the dividend that the company pays me out of the corporate earnings that it has. The idea behind integration is that they want to try to make sure that the total tax paid to the CRA is the same, no matter how you structure your affairs, right? The idea is that if I pay personal tax on the income as an individual, this should be equal to the sum of my corporate tax and personal tax if I have a corporation. That's the theory. That's the theory behind integration. Now, in reality, ladies and gentlemen, integration may or may not work, either at all, well, or perfectly. It largely depends on tax rates in a particular province, because integration is a federal tax concept. But each province and territory in Canada can set their own tax rules that are applicable for provincial tax purposes. And sometimes those provincial rules don't really jive with the federal rules, which might create a lack of integration for some income or over-integration for other income. And this impacts forms of compensation. So in certain cases, depending on the kind of income a company might earn, you may choose to pay additional salary or pay a bonus because it creates a lower tax cost, for instance. In other cases, you may choose to pay a dividend because it's better. In other cases, you may choose not to pay anything because you're going to have a large amount of deferral and you perhaps want to postpone as much as you can the payment of personal tax. Okay, so let's take a quick look. I'll go through these things fairly quickly because I'm pretty sure you've seen these before. And I'd like to get to the practical component of our session, which is doing some actual numbers and looking at a case study. Okay, in the following few slides, I'll show you what integration looks like in Ontario. Here, we're assuming we're dealing with a person who's in the highest personal tax bracket, that we're not dealing with any kind of EHT, just for simplicity, and we're assuming that we have enough grip to pay out eligible dividends when we need to. Okay, so first of all, here's how integration works for small business income. Small business income. If a corporation earns $100,000 of small business income, it pays tax at a lower rate, 12.2%. Eventually, it'll pay out a dividend which is non-eligible to your owner-manager. At the end of the day, my owner-manager has $45,000 roughly in their pocket on an after-tax basis. If the company didn't do this, and if the person earned income directly, or if the company earned the income and paid the whole income out as a bonus or salary, which will effectively shift all of it away from the company into the hands of the individual will be taxed like this, and they would have roughly $46,000 of cash on an after-tax basis. So notice, there is a slight, very slight tax cost to earning income in a corporation and then later paying out a dividend. It's not huge. It's only about 0.6%. But there's a pretty significant deferral. What do we mean by deferral? If the corporation chooses not to pay a dividend, it's going to have $87,000 in its corporate bank account. compared to the individual having $46,000 in their personal bank account. So if the individual can afford not to pay themselves, and if they can decide to leave the money in the company, as we sometimes call it, they're going to postpone or defer $41,000 of personal tax, which is not a bad deal. So what does this mean for compensation, ladies and gentlemen? Notice we have a large deferral and a very small overall cost to paying out a dividend. This kind of income lends itself to, if you can, leaving it in the company for as long as possible and not paying it out. Why? Because by doing so, you are deferring 41% of your income in the form of taxation. And that's a lot of money. Your corporation is going to have tons more cash to be able to grow, to invest, hire more people, buy more equipment, etc. Ultimately, if you do decide to pay a dividend or a salary, the difference between the two is very minor. It's 0.6%. So it's not a huge difference. So it doesn't make a huge really change one way or another, whether you pay a dividend or a salary for this kind of income. Okay, let's take a look at general rate income. So this is where I don't get the small business deduction. I'm paying tax at the general corporate rate in Ontario, 26.5%. So here's my income of 100 grand. I'm paying tax at 26.5%. Here's how much I have on an after-tax basis in the corp. I pay this out as an eligible dividend to my individual, and my individual has $44,000 in their pocket on an after-tax basis. Compare this to a situation where the individual simply earns the income directly. We're looking at 46. So notice here, there's a little bit more of a tax cost. It's about 1.9%. So by using a company to earn this income, I'm paying more in tax to the CRA essentially. And I still have deferral, 27% roughly, but not as huge as it was for small business income. So what is the ultimate sort of decision here, or what's the takeaway from a compensation point of view? If you have a corporation that earns this kind of income, you have a bit of a choice to make. If I defer tax by leaving the money in the company, later I'm paying myself a dividend, and it's going to cost me 1.9% more in tax overall. So which one do I want, deferral or tax cost? Alternatively, if I'm looking to pay something out of the company, it's not a bad idea to pay this kind of income as a salary or a bonus. Why? Because by doing so, you're going to avoid this 1.9% tax cost on the payment that you're making. And so on 100 grand, you're looking at about $1,900. On 500 grand, you're looking at about almost 10 grand, just by structuring the payment as salary versus a dividend. So, and this is especially true for an individual if they've already contributed the maximum to the CPP, maybe based on their existing salary, and EHT is not applicable. So this kind of income kind of lends itself to being paid out as a salary as opposed to a dividend. Okay, now in Ontario, ladies and gentlemen, we have a little bit of a unique situation that I alluded to earlier. Income that is eligible for the small business deduction is taxed at a lower rate, 12.2 instead of 26.5. This is available on $500,000 of business income per year, commonly referred to as the small business limit or the SBD limit. This is only for CCPCs. Okay, now a few years ago, the federal government, starting in 2019, introduced a new rule that basically said this: if a CCPC earns too much investment income, they're going to start to lose their small business limit. And how much is too much? More than $50,000 per year. They're willing to tolerate $50K per year. Anything more than that, they're going to start reducing the small business limit. So for example, if my passive investment income is under $50,000 in Ontario, I still get the full $500,000 small business limit. If it's over $150,000, my small business limit for federal purposes is reduced to nil. And if it's somewhere in between, then my small business limit is prorated. So for example, if I have $90,000 of passive investment income, my small business limit will be reduced down to $300,000. And this is based on the income of all associated corporations, ladies and gentlemen. So if I'm part of an associated group, I got to calculate my investment income for everyone and add it together when I'm doing this calculation. Okay, now here's what's interesting in Ontario. These rules were introduced by the federal government. The Ontario government, which by the way is of a different political persuasion, as you might know, decided not to apply them provincially. So they said, you know what, in Ontario, we don't care about investments. You want to invest? Go ahead. We'll still give you the full small business deduction provincially. So what does this mean? You could have a situation where a company who has a whole bunch of investments will lose some of their small business deduction at the federal level, but will keep it at the provincial level. And this potentially creates an over-integration opportunity because you're going to have a bit of an unusual tax rate here. And here's what taxation of this income is going to look like. If you have 100 grand of income and it's not getting the small business deduction federally, but it is getting the small business deduction provincially. The corporate tax rate will be 18.2. It's a combination of the normal federal tax rate of 15% on regular income and the small business rate of 3.2% in Ontario on small business income. It's a bit of a weird rate. As a result, we're going to have more money in the corporation than we otherwise would. And when we're paying a dividend out, part of it is going to be eligible, part of it is going to be non-eligible. And so for that reason, we're going to end up with a little bit more money on an after-tax basis than we otherwise would have. So notice, folks, for this kind of income, we still have quite a bit of deferral. That's the difference between these two numbers. If I don't pay anything out, I'm deferring a whole bunch of tax. But eventually, when I do pay out a dividend specifically, I'm going to actually save a little bit of tax because this income is over-integrated. So for compensation purposes, this kind of income is not a bad idea to actually be paid out as a dividend, because you should be able to realize some tax savings there due to this over-integration. And this is purely a function of the fact that the Ontario government decided to do something different. So there's a mismatch in how that income is treated between feds and Ontario, creates a positive situation in Ontario, actually. Okay, if I'm earning investment income, things like interest, rents, royalties, taxable capital gains, which we call aggregate investment income or AII, this thing is subject to tax at a very high rate, 50.17%. However, 30.67% of the income goes into a special account called non-eligible RDTOH, or NERTO, if you prefer that pronunciation. NERTO is refundable. Eventually, when I pay Michael, you're laughing. I love it. I love it. Finally, some humor. Great. NERTO is refundable when a corporation pays out a non-eligible dividend. So for me to get this money back in the corporation, I got to pay a dividend out that is non-eligible. The payment of the non-eligible dividend triggers personal tax, which will be this much for an individual. So my individual is going to be roughly at $42,000 of after-tax cash when all is said and done. However, if this income was earned directly by the individual and they didn't have a corporation, they would still be paying tax at the highest marginal rate of 53. They would still have 46 grand in their pocket on an after-tax basis. So folks, notice something. Investment income, when you earn it through a corp, you're actually paying more tax on it overall. So for anyone who's thinking of, you know what, I have some investments that I hold personally, let me transfer them to a corporation because I heard corporations are these magical creatures that create great tax results. Well, for this kind of income, that doesn't actually work very well. You're actually going to pay more tax overall, and there's virtually no deferral. The difference between this number here and that number here, the taxes that are initially paid, that's not a huge difference. It's only about 3%. So what are the compensation sort of takeaways for a corporation that's earning investment income? Minimal deferral. Generally speaking, it's a little bit hard to take a salary out of investment income because investment income by nature, it's passive. You don't really earn it through somebody's labor. So typically, CRA might have an issue with you deducting a salary against it. So typically it's paid out as a dividend. So the idea here is that if your owner requires funding, consider paying out non-eligible dividends. Why? Because they are going to trigger a refund of the non-eligible RDTOH. So at least you can recover that tax in the corporation in exchange for the personal tax that you're paying on the personal side of things. Okay, and last but not least, what if I'm earning public company dividends? All right, corporation might have excess cash. They may decide to, for instance, buy public company shares. They might pay dividends. Well, dividends, ladies and gentlemen, are the only kind of income that is perfectly integrated in Ontario, which means if I receive dividends, I'm going to pay something called Part 4 tax at a rate of 38.33% on these types of dividends because they're non-connected. The entire amount of Part 4 tax is refundable. It goes into eligible RDTOH if the dividends are eligible, and most public company dividends are in fact eligible. So I pay this today, but I get this back later. So my net tax really in the company is nil when I factor in the payment of the dividend out to a shareholder. So my shareholder will be in exactly the same after-tax position, regardless of whether they earn these dividends through a corp or whether they earn these dividends personally. They're going to be in exactly the same position. So what's the moral of the story here? There's zero cost or savings here and very minimal deferral. So you can earn them through a corp, you can earn them personally, not a huge deal. Now, when you're earning eligible dividends on public company shares, because they're eligible, they create GRIP. And so you can take the GRIP and pay it out as eligible dividends to your owner manager. That is preferred, for instance, to paying, for example, a non-eligible dividend because there's less personal tax on that kind of dividend. And if there's eligible RDTOH or ERDTO, if you prefer that pronunciation, then we will get that money back. All right. So that's kind of the idea between this and what compensation may look like for these types of incomes. Folks, I'm going to pause here for a second. We're going to shift gears. I'm going to show you an example, and we'll kind of start thinking about that. Okay, ladies and gentlemen, for your consideration, we have a little example here to share with you that we'd like you to take a look at. Okay, we have a company called Canadian Consumer Products Corporation, acronym CCPC. Coincidence? I think not. They sell consumer products, all right? And they use their after-tax funds to buy investments, things like shares, bonds, things that are publicly available. They don't have any associated corporations. This is the only company they have in their group. And there's a mom and a dad, and mom and dad run the business together as a team, okay? Each one of them currently receives an annual salary of $250,000 per person. So that already puts them in a pretty high tax bracket for simplicity. The ownership of the company is as follows. Mom holds 100% of the preferred shares. Perhaps there was an estate freeze done at some point in the past. And they created a family trust. Family trust holds 100% of the common shares. That is one of the beneficiaries of the trust. And they have a couple of kids who are also beneficiaries. So this kind of gives you a little bit of an idea as to what's going on in the corporation. You'll notice that if you take a look at the balance sheet, the company has $350,000 of cash. And the owners say, you know what, we want to take out $300,000 of cash out of this corporation because, we have a lavish lifestyle, okay? We like to live it up. So we want to take out $300,000 in cash, leave the other $50K of cash in the business because, we need it for working capital purposes. And naturally, they want to do this in a tax efficient way, okay? So ladies and gentlemen, here's my ask of you. Please take 5 minutes. Please review the financial statement and the T2. And can you please tell me, are there any tax attributes? Are there any balances here that you might see that maybe are somehow relevant for us to decide what to pay these people in the form of $300,000? So please take 5 minutes. Please review the financial statements, the T2, and ask yourself, okay, what here might impact compensation somehow? Okay, please go ahead. Please go ahead. So folks, 2 more minutes, just 2 more minutes. And then I'll ask you to maybe let us know what you think is relevant here. So please take 2 more minutes. Okay, ladies and gentlemen, so thank you. And again, I know it's asking a lot during a training session to actually do something as opposed to just passively listen to what's going on. I see Holly and Michael are smiling. I don't know, maybe I'll onto something here. But anyway, for those of you who were able to hopefully participate, please, folks, let me know. Please let me know in the chat, okay? Is there anything that you've seen here in the financial statements T2 that might somehow be relevant for us if we're deciding to pay $300,000 to these people, particularly from the point of view of what can we use somehow to minimize tax implications. So please let us know. What does this company have that might be helpful, if anything? If there's nothing there, we'll just pay out a big salary and be done with it. Okay, Sabrina, Ricky, thank you. Veronica, yes. So we definitely have CDA, for sure. We definitely have GRIP, for sure. Yes, there is RDTOH, the NerdTO kind, and also the ERDTO kind. So there's both of those. Yes, there's also GRIP, definitely. Yeah, Robert, for sure. Yeah, there's definitely capital gain. We'll assume there was no CDA from before, so yeah, there's probably CDA. All right, great. And yeah, someone mentioned Ben, thank you, as well as somebody else. Yeah, there's also a shareholder loan on the balance sheet. So that can be paid out tax-free probably, right? All right. Okay, so let's check this out. Okay, so folks, here are some of the balances that would be relevant for compensation. And folks, I appreciate that some of you here are very experienced. To you, this is like, okay, yeah, I've heard this before. But there's people here that maybe are not familiar with these things, and for them this is like, oh, I didn't even know what this was, and now I hopefully understand. Okay, so we have 2 types of RDTOH, non-eligible and eligible. Okay, you can find these on the T2 jacket. Here's the page and the line in case you want to find where it is. These things can be recovered by the company if they pay out a certain kind of dividend, so that may impact how we decide to compensate our owner manager as a result. Okay, there's also GRIP. This is coming from Schedule 53. So this means that the company earned some kind of income that was taxable at the general corporate rate. In this case, there's business income that's taxable at the general corporate rate. There's also dividends that they receive from public companies. Both of those things create GRIP. So this means we can pay out an eligible dividend of up to $500,000. Perhaps that's going to be useful to us when we're deciding how to compensate our owner manager to the tune of $300,000. Okay, there's also likely some CDA. Okay, now if you took a look at Schedule 6 as well as Schedule 1, you would have noticed there's a taxable capital gain of $50,000 this year. Now, you may also maybe see sometimes a schedule called Schedule 89. Schedule 89 is a schedule that in tax prep will calculate CDA and keep track of it over time. I purposely didn't put it here to hopefully see if people pick up on what creates CDA. It's capital gains that create CDA. That's the most common example. I guess, okay, on the federal summary, I guess they'll tell you as well. And last but not least, certainly, on the balance sheet, there's a due to shareholder. That means the shareholder must have lent money, or the shareholder maybe paid for something on behalf of the corporation. And guess what? We can pay them back completely tax-free. Okay, so ladies and gentlemen, now that we've identified some of these attributes, let me ask you the following question. Okay, we want to pay, remember, our owner manager wants to pay out $300,000 of cash to themselves in total. Naturally, their objective is we want to pay as little tax as possible. So what would be the first thing that you would probably want to pay out here? Based on these different attributes that we have identified, what would be the first thing that you would want to distribute? And why? And again, I appreciate I'm asking people to get involved, which is hard to do, but nonetheless. Yeah, absolutely. Yeah. Kathy, Sabrina, Jeremy. Yeah, for sure. You probably would want to pay these two things out first, for sure. Why? First of all, they're both tax-free, right? So naturally, if there's a distribution that can be done tax-free, I'm sure your shareholder probably would prefer that over everything else. So the first thing that you probably would want to pay out is anything that is a tax-free distribution. So I personally would argue you probably would want to pay out the due to shareholder first, okay? Why? It doesn't require any kind of reporting, doesn't require any kind of T-slips, withholdings, filings. It's strictly a reimbursement or a distribution of money that the shareholder provided in the past. So easy peasy, pay out 22 grand, completely tax-free, reduce your shareholder loan down to zero, your cash goes down by 22,000 bucks. Okay, next, CDA. CDA can also be distributed tax-free, but CDA requires a little bit more effort for distribution. Some of you may know that in order to pay out a capital dividend out of CDA, you need to file a special election with the Canada Revenue Agency. There's a form called Form T2054, which needs to be prepared. You need a certified copy of a director's resolution. That means your client has to prepare a director's resolution. They'll probably tell you, I don't know how to do one. You do it for me, or you get a lawyer involved. And you also have to provide a calculation of the CDA balance. You can use Section 89 for this purpose. In the past, we would use an Excel spreadsheet, for example. There's also no T-slips or withholdings, but notice, this is very little effort. This requires a little bit more effort. There's an election that has to be filed. There's a deadline for that election. If you miss the deadline, there's a penalty of $42 a month. So there's a little bit more headache associated with CDA, but nonetheless, those two things can be paid out tax-free. Okay, folks, fantastic. I agree with you 100%. Okay, so now let's say we've paid out the CDA. Let's say we've paid out the due to shareholder. Given the fact that we have these remaining attributes, we have GRIP, we have eligible RD2H, non-eligible RD2H. What would be the next thing that you might want to distribute? It won't be tax-free, but maybe it's going to have some kind of efficient tax result, better than maybe some other one. What do you guys think? Okay, yeah, Jeremy, Sabrina, Kathy, thank you, for sure. We have a GRIP of 300 grand, so we can pay out a pretty significant amount of eligible dividends. Now, you for sure would want to pay out an eligible dividend, and some people said 30,000. Sabrina, Jeremy, it may not be obvious to everyone why you picked 30,000, but you're absolutely right. So if you divide the eligible RD2H by 38.33, 38.33 is the rate at which $1 of dividends creates a refund in the RD2H. So to recover the whole amount, you're going to need a $30,000 dividend. Or if you want to work backwards, take $30,000 and multiply it by 38.333%. You'll notice that you'll get exactly 11,500. So the next thing, and Sabrina, Jeremy, I agree with you 100%. You probably should pay an eligible dividend of $30,000. Now, why? Eligible dividends are subject to a relatively low rate of personal tax. Our owner managers are in the highest marginal tax bracket. For them, eligible dividends will create a tax cost of 39.34% personally. But at the same time, through the payment of that dividend, the corporation will recover RDTOH at a rate of 38.33%. So when you consider both of those sides of the picture, personal tax and corporate tax, the net result is actually quite advantageous. There's not a large tax outflow here because the personal tax that's paid by the individual is largely offset by the refund of RDTOH that's collected by the corporation. Okay, fantastic. Okay, so let's suppose that's the next step. We've paid out 30K of eligible dividends. We've now recovered eligible RDTOH in full. Okay, we still have a GRIP left over of 270K at that point. We still have some nerd toe hanging around. What would be the next thing that would be probably advantageous from a compensation point of view. Our eligible RDTH is now recovered in full. What would be the next thing that you might want to consider here? We have GRIP, which means we can pay out eligible dividends, and we also have non-eligible RDTH. Okay, so folks, let me management bonus, maybe. Jeremy, maybe there's something else we can pay before a bonus that might be a consideration. Okay, Sabrina. Fantastic, you're on the ball. Folks, question for you, okay? If I have GRIP, that means I can pay eligible dividends. Will eligible dividends get back non-eligible RDTOH? Yes or no? Can I get back non-eligible RDTOH with eligible dividends? Yes or no? Okay, some people say yes. Mike, what do you think? I think I saw you going like this, which I'm assuming the answer is no. Jeffrey, Holly, what do you guys think? Yes, no? I plead the fifth at the risk of self-incriminating myself in front of the entire partnership group. I plead the fifth. I choose not to answer. I choose not to run, as Jerry once said in Seinfeld. Yeah, the answer is no. Okay, the answer is no. Why? Because of these new RDTOH rules that were created by the federal government in 2019. Okay, they split RDTOH into eligible and non-eligible for the explicit purpose that non-eligible RDTOH cannot be refunded if you're paying out eligible dividends. It screws up integration. Okay, so here, if you want to pay out eligible dividends, you're going to get a lower tax rate personally, but the corporation is not getting back the non-eligible RDTOH, unfortunately. If you want to recover the non-eligible RDTOH, you got to pay out non-eligible dividends. And a CCPC at any point in time can pay out a non-eligible dividend because a GRIP only restricts eligible dividends. Non-eligible dividends are, if the company has money and retained earnings, go ahead, pay it out. Divide the NERD by 38.33. I couldn't have said it better myself. Bingo. You're going to get $48,000. Or if you want to double check this, take $48,000 multiplied by 38.33, and you should get $18,400. So what does this mean? If I pay out a non-eligible dividend, yes, it's going to be subject to a higher personal tax rate. That's true. But my corporation is going to get a big refund. So on a net basis, this is not a bad situation. This is not a bad situation. Socrates lives. Jeffrey, love your comment. Okay, so folks, here's probably the next thing you want to do in this example. And this is kind of the whole reason why I created this example, is to have different kind of attributes to kind of illustrate what would this mean. You would want to pay next an eligible dividend of $30,000. Why? It'll recover eligible RDTOH of 11.5, and it's still subject to a pretty low personal tax rate. So a pretty good dividend to pay with the extra added advantage of recovering eligible RDTOH as well. Not too shabby. The fourth thing you would probably want to do is let's trigger a refund of the NERD, as Sabrina called it. We have NERTO of $18,400. To get a refund of that, we got to pay a non-eligible dividend. That's the key. It has to be non-eligible of $48,000 even. Okay. Notice both of these are dividends, right? So what does this mean? I got to file a T5 slip. There's no withholdings. That's the good news, I suppose. And I got to report the payment of the dividend on my Schedule 3 of the T2. That will then trigger a dividend refund on the jacket. Okay. So there's some administrative / reporting work to be done with the dividend, but hopefully it's worth the effort. Okay, so folks, let's just sort of recap what we've done so far. Ellie, I'll get to your question in just a moment. The answer is yes, but the focus of our session today is not capital gain stripping. That's a little bit more advanced. The focus today is to focus on the sort of the fundamentals. But yes, capital gain stripping potentially could be an idea, but here the owner just wants 300K and they want it now. So maybe capital gain stripping is not something that you can quickly turn around for them, perhaps. Okay, so folks, here's, no worries, Ellie, but great question nonetheless. So folks, here's a quick summary of basically what the overall tax impact is of us distributing these different funds out of the corporation so far, right? We've paid $22,000 as a repayment of due to shareholder. It's tax-free. There's no tax to anyone. We've paid out $50,000 in the form of a capital dividend. Once again, it's tax-free. There's no tax implications to anyone here. You got to file an election though, but nonetheless. Next, we're going to pay out a $30,000 eligible dividend. That will create personal tax at a rate of 39.34%. So take 30,000, multiply it by 39.34%. You should get 11,802 as the personal tax associated on that dividend. There's no withholdings, by the way. So the individual is going to have to hopefully remember to set aside some money to then pay the tax at a later point in time. But here's the thing, though. The payment of this dividend recovers RDTOH, the eligible kind of RDTOH, at a rate of 38.33%. That's what this is. So if you look at the entire picture, if you look at what's happening to our owner manager, what's happening to our corp on a net basis, the CRA is only collecting an extra $302 from us overall. Our company's getting a refund, the individual's paying, but on a net basis, there's only $300 that's leaving our group, let's call it. A pretty, I would argue, tax efficient way of paying yourself. You're going to pay tax, sure, but the company gets a whole bunch of money back. So not a bad situation. Okay, next, we've got $48,000 of a non-eligible dividend. So a non-eligible dividend for an individual who's in the highest marginal tax bracket is taxed at a rate of 47.74. So that's how you get this number, 22,915. However, the non-eligible dividend will recover RDTOH, the nerd kind, at 38.33. That's how we get this number. So notice, again, we're going to obviously pay personal tax, and there's more personal tax paid on a non-eligible dividend than there is on an eligible dividend. So arguably, this is the worst kind of dividend, if you will. But the corporation is still going to recover a whole bunch of funds as a result. It's going to get RDTOH back. So the net of these two, notice, is only about $4,500. Yeah, the individual pays a bunch of money. The corporation gets a whole bunch of money back. And again, if you look at it from an overall picture point of view, pretty tax efficient way of paying yourself out. Only $4,500 total going into the coffers of the CRA from some combination of you and your corporation. So folks, overall, so far, we've taken out $150,000 out of our corporation. And notice we are only paying on a net basis $4,800. What do you guys think? Pretty good? I'll take this any day of the week, quite frankly. If I can do this not weekly, but I guess annually, sign me up, right? Because on a regular salary, you're paying 53%. Well, not me. I'm not in the highest marginal tax bracket like some folks here, but one day. So anyway, this is our overall sort of summary here. So yes, individual is going to pay $34,000. Corporation gets back almost $30,000. The net tax CRA is collecting from us is $4,800. Folks, I'm going to pause here just for a moment. Does anyone have any questions? Please feel free to ask. Feel free to send me a private message if you don't want Holly or Mike knowing what you're thinking, which is totally cool. No worries at all. Okay, I've got a question. If the husband is not the shareholder himself, it's the trust, then he can't be paid a dividend, right? Okay, fantastic question from the person that's asking the question. You may recall a few slides ago, I told you folks that the ownership of this company is as follows. Mom holds preferred shares directly. There's a trust that holds common shares, and dad and the kids are beneficiaries of the common share of the trust, sorry, that holds the common shares. And most family trusts are discretionary. Discretionary means the trust can allocate income to basically whichever beneficiary they see fit. So great question by the person that asked the question. A dividend can be paid into a trust and can be allocated as a dividend of the same kind, whether it's eligible or non-eligible, whatever, to a particular beneficiary. What you have to worry about in that situation really is TOSI. Would TOSI be a problem in that consideration? You may recall that our dad is running the business alongside the mom. So they're both actively involved in the business. And if you're actively involved in the business, you qualify for an exclusion from TOSI called the excluded business exception. So a fantastic question that was asked. The answer is you can pay a dividend. It'll have to go into a trust. The trust would have to allocate the dividend out to dad in this example. That can be done, yes. Will TOSI be a problem? In this case, no. But that will require a T3 return, a T3 slip from the trust, which adds a little bit more complexity. Yeah. Now, folks, while we're at it, the other thing I want to point out that some people perhaps might be thinking about, notice that mom holds preferred shares, and it's not uncommon to see a structure where there's maybe a founder of the company who is holding preferred shares, maybe because they did some kind of share exchange to freeze the value of their shares to pass the future growth to somebody else. It's fairly common. Whenever you have an owner that holds preferred shares, before you start declaring dividends to them, you might want to check what are the characteristics of those preferred shares. Because preferred shares, for instance, could have a fixed dividend, meaning that there's only a certain amount of dividend that the company can pay on preferred shares. And perhaps the dividend that you want to pay out exceeds that amount. So that's one consideration. Another consideration, and I'll mention this again a little bit later at the end of our session here today, is if a person has preferred shares, it's possible that they have a fixed value on those shares and a fairly low cost or PUC. And that is what you typically see if a freeze was done at some point in time. If that's the case, you may consider maybe redeeming some of those preferred shares. A redemption is where the corporation buys some of those shares back, and the difference between their value and paid up capital creates a deemed dividend. And that deemed dividend could be classified as a capital dividend, as an eligible dividend, as a non-eligible dividend, depending on what parameters you have in existence in your corporation. And we call this type of planning technique a wasting freeze. Some of you might have seen it. I know at Fuller there's some clients that have done this technique, because I remember reviewing certain T2s that had it many years ago. In any event, that gives you the added benefit of not just paying somebody a dividend, but also removing some of the shares that that person has. And the benefit is, if that person eventually dies or sells their shares, they're going to have a lower capital gain to deal with. So that's an additional little wrinkle when it comes to compensation that you might want to consider. Look at the actual shares that people hold. Do those shares have the ability to receive dividends? That it's not a foregone conclusion that they do. Common shares certainly do, sure. Preferred shares, maybe, maybe not. And also, would it make sense to maybe redeem some of those preferred shares? Perhaps, perhaps. So great question for the person that asked it. Folks, are there any other questions so far about what we've looked at? Again, please ask. Jeffrey says no, so I think if Jeffrey says no, it's time to move on. Okay, so folks, notice, ladies and gentlemen, so far we've taken out $150,000 in cash out of our corporation. I would argue on a relatively good basis. All right, total net tax cost about $4,800. Shareholders, they want $300,000, so we still need to take out an additional $300,000. Sorry, we need to take out an additional $150,000. Because we've taken out 150, the owners want 300, so we got to take out another 150. So folks, how should we pay the additional $150,000? Notice we've taken out all of our RDTOH, both the eligible and the non-eligible kind. We've paid off the CDA. We've paid off the shareholder loan. So really now what we're dealing with is more of a traditional form of compensation, which is, well, I have no special attributes here that I can use. I mean, yes, I have GRIP still, so maybe the dividend I can pay could be eligible, perhaps. Okay, fine. Do I do a bonus? Do I do a dividend? Do I do some combination of bonus or dividend? That really becomes kind of the question. And folks, whenever you're dealing with this kind of situation, the best thing you can do is run some calculations, okay? Pretend that you're paying out a bonus, run the numbers, see what happens. How much personal tax is going to be triggered? How much corporate tax will you save? Pretend you're paying out a dividend. What happens? How much corporate tax will there be? How much personal tax will there be? And then basically compare the results. Compare the results. Mike, still need money to pay the corporate tax bill. Yeah, well, that's a good point, Mike. Yes, you will definitely need some money to pay the corporate tax bill. That's true. But, you know, the company's got a whole bunch of actually, no, they don't have that much accounts receivable, I suppose. Valid point, Michael, valid point. Maybe they're expecting, you know, a plethora of money to come in after the holiday season, and they're just waiting on a whole bunch of receivables, but fantastic point. Okay, so folks, let me show you what you might want to do if you're considering this question. Okay, do I do a bonus? Do I do a dividend? What do I do? First of all, let's look at, oh, by the way, first of all, let's look at the company's income, okay? Folks, if you look at the T2, you'll see that there's total income on the, for financial statement purposes of 740,000. 50 grand of that is CDA, so we take that out. So our total income really is 690. And 30K of that is dividends, which is excluded from taxable income. So really our taxable income is all this. Our taxable income is 660K. Now, I don't know if you've picked up on this or not, but we have some investment income. Obviously, we have $60,000 of investment income here, but we also have a whole bunch of business income, and we have a couple of different varieties of business income. This corporation, if you take a look at Schedule 7, last year, and also you see this on the financial statements, last year had $90,000 of investment income. And what that means for us in the current year is that our small business limit for federal purposes is reduced, but for provincial purposes, it remains as is. So really what's happening in RT2 is we actually have the application of 3 different tax rates that are happening all at the same time on different levels of income. The first $300,000 of our active business income gets the small business deduction in full, both federal and provincial. Tax rate is 12.2%, total corporate tax $36,600. The next $200,000 continue to get the Ontario small business deduction, but not the federal. So as a result, we have this unusual tax rate of 18.2, which is costing us $36,400 on that $200,000 of income. And last but not least, the additional 100 grand is not getting the small business deduction at all, neither federally nor provincially. Therefore, it's taxable at 26.5, so it's costing us 26,500. All right. Dividends, we're going to recover 11,500 through in Part 4 tax when we pay out an eligible dividend, and a whole bunch of this is what we're recovering when we pay out non-eligible dividends. So really focus on this. So notice, ladies and gentlemen, if you pay out a bonus is a deductible expense, so it's going to lower this income. Many years ago, for those of you who remember, we used to have a term called bonusing down. The idea was if you have income above the small business limit, let's create a bonus to bonus it down to below the small business limit or at the business limit. Well, if you apply that strategy, you're going to save corporate tax, but you're going to pay regular personal tax. Is that good? I don't know. If we run the numbers, we'll find out. Alternatively, if you pay out a dividend, you're still paying corporate tax, but the dividend that you're paying is subject to a lower personal tax rate. Is that better? I don't know, but if we run the numbers, we should be able to find out. So with this in mind, and I realize we only have about 50 minutes left here, let's take a look at a couple of calculations to see what in this case might be the best result. So here's alternative number 1. Let's pay out the additional 150K as a bonus. Okay, so what is that going to do? The bonus will reduce the business income of the company by $150,000. First of all, the bonus, when you receive it as an individual, you're going to be paying tax on it at the highest marginal personal tax rate. Both of our owner managers are already in the highest bracket. So whoever gets the bonus, or if it's split 50-50, whatever, either one of them is going to pay 53%, end of story. Now, there's going to be a reduction to the corporate tax that the company would pay as a result of paying this bonus. The company will save roughly $35,600 of tax. How so? 100K will reduce tax that was paid on general rate income at 26.5%. The other 50 will reduce tax that was paid at the blended rate of 18.2. So collectively, that gives us $36,500. So notice, if I pay a bonus out, there's going to be personal tax of about 80 grand, but the company will save corporate tax of about 35. So the overall total tax cost, if you net these two numbers, is about 44,600. Okay, not too bad. If I pay out a dividend, ladies and gentlemen, notice I still have sufficient grip here. I still have a whole bunch of grip. So if I decide, if I can choose, I could pay out an eligible dividend if I decide to do so. I have sufficient grip. So if I pay $150,000 as an eligible dividend, there's going to be tax on that at 39.34%, which gives me a total amount of personal tax of about $59,000. And notice, folks, when you pay a dividend out, a dividend comes out of after-tax corporate earnings. You know, if you put on your accounting bookkeeping hat for a moment, it comes out of retained earnings, really. And retained earnings is income that was already taxed in the corporation. So the payment of a dividend is not going to lower our tax bill. We're still going to pay the same amount of corporate tax. We're just going to distribute some of that after-tax profit as a dividend. So there's nothing happening in the corporation, and therefore the total tax cost here is about 59. So it's a little bit higher. Now, lastly, if we look at alternative number 3, somebody might say, well, how about if we do a split? Let's do a partial bonus and a partial dividend. And here, some of the payment that you're receiving will be taxed as a salary. Some of the payment you're receiving will be taxed as a dividend. The total amount of tax collected will be about $73,000. And then the reduction in corporate tax will just be for the portion that is paid out as a bonus, not as the dividend, saving us about $26,500. So there's going to be a total tax cost here of about $46,000. So if you compare these three scenarios, it seems like in this situation, perhaps paying out a bonus is the way to go. Now, if your bonus may trigger EHT, perhaps maybe you have other things to consider. When you're paying out a bonus, you got to worry about, well, is the bonus amount reasonable? CRA has a long-standing administrative position that says as long as you're paying a bonus to an active owner manager, anything is reasonable. But if you're paying out a bonus to somebody else, you got to worry about how is the amount kind of earned or determined. So in this particular example, perhaps a bonus might be the best way. But what I'm trying to say here is you need to do a calculation to figure out what would be better, and consider both sides, consider the individual and the corporation. So folks, overall, notice what's happening here from a total point of view. Our corporation, CCPC, distributed $300,000 to its shareholders, all right? Some of it came out as a shareholder loan, tax-free. Some of it came out as CDA, tax-free. Some of it came out as dividends. We picked specific amounts of dividends to get back refunds of RDTOH, both the non-eligible kind and the eligible kind. And overall, our net tax cost, net meaning consider the personal tax impact and the corporate impact. Overall, we're looking at a net tax cost of about 50 grand. Again, personal tax minus the corporate tax that you're paying. So is this a good result? I don't know. To me, seems to be pretty decent. Now, instead of doing all of this, you could have just paid a salary of $300,000 or a big dividend of $300,000. But if you do the numbers, your cost will be much higher because you're not taking advantage of tax-free items. You're not taking advantage of fully the refunds that would be available to the corporation if certain kinds of dividends that are paid. So, ladies and gentlemen, overall, how should a shareholder pay themselves out of their corporation while hopefully minimizing the tax impact? What I would suggest is look for tax attributes, things that a corporation can distribute in a tax efficient way, things that a corporation can recover if they make a certain kind of distribution, and then do a calculation to compute the overall cost of other payments, bonus, dividend, et cetera, et cetera. Overall, some accounts that I've talked to, they go straight to this idea. They say, okay, well, we do have two options, big bonus or big dividend, whichever one's better, let's go with that. Well, there could be other little wrinkles here that if you take advantage of them fully, you'll actually put your shareholder manager in a better spot. And hopefully you'll have no problem collecting WIP from them because they're going to be a happy client. Some other considerations, ladies and gentlemen, and we're just about out of time here, so we're not going to talk about these too much here now, but some other considerations. Well, is it possible to maybe split income with other family members? Notice some of the things we're paying out are dividends. So a dividend could potentially be paid to a family trust, could potentially be allocated to one of the kids, let's say. If the kid is a minor, we're going to have a TOSI issue, so we can't do that. If the kid is not a minor, maybe we can do it depending on how old the child is. Are they involved in the business? Or if, for example, I have a child who's 25 or older, they could qualify for an exception from TOSI called excluded shares. You might have heard of it. If we put some shares into that individual's hands directly, as long as they hold at least 10% of the shares, the business is not a personal, is not a PC, and this business isn't. As long as at least, as long as no more than 90% of its income is from services, this company sells products, there's no services, then that individual could be excluded from TOSI as long as they're of a certain age, 25 or older. And so that could be a strategy here if the family wants to maybe split income with one of their kids that's old enough. So whether TOSI is something that people have interest or not, I'm not sure, but that could be another consideration here is who's physically getting these dividends, let's say. It should be mom and dad, or could it be maybe somebody in the family? Maybe you can stream it to somebody else in the family, which means they're going to pay tax at a lower rate, which means your overall tax cost will be even lower as a result. And lastly, the quick strategy that I mentioned earlier, the concept of a wasting freeze. If you have preferred shares outstanding, consider redeeming them. Instead of paying dividends to all those shares, redeem them. That has the added benefit of reducing the amount of shares outstanding, reducing the value that's outstanding, so that eventually if the shares are sold or the person dies, there's a lower capital gain to deal with. And public service announcement from Mr. Brown. Always know whether your client or prospect is a U.S. person and advise accordingly. Yes, because folks, and Jeff and Holly, please correct me if I'm wrong. From what I hear, IRS agents are authorized to carry weapons, I think, in the US, or at least that's what I've read online. I don't know if that's true. You don't want to mess with those people, okay? You want to make sure that in Canada, we don't do that. In US, it's a different world. So you definitely don't want to get on the bad side of the IRS because who knows what's going to happen then. Criminal agents only, okay. There you go, Jeff, there you go. Folks, overall, couple of quick questions for you here before we sort of part. First of all, please tell me in the chat, and please be honest. Was this a helpful session? I realize we're talking about the fundamentals. I get it. So for some of you, this might be like, Alex, I've been doing this for 20 years. But for someone who's not doing it for 20 years, this perhaps may be new information. So call your lawyer if they show up. Okay, fantastic. Great. For those of you who participated, for those of you who are here, fantastic. Thank you. I'll leave it up to you and Sherry as well. If there's interest, we can potentially do an advanced session. We can think about TOSI. We can think about redemptions. We can think about maybe a reorganization that will create some kind of better compensation strategy. So here, the purpose was fundamentals. In the future, if we do this again, we can do something maybe more advanced, or we can look at another topic altogether. Okay, ladies and gentlemen, and with that in mind, I'd like to say thank you. Thank you for attending. For those of you who participated, thank you for participating. For those of you who had your camera on, Holly, Jeffrey, Sabrina, and Michael, who I guess got tired and left. There he is. Thank you again. Having someone on camera makes a huge difference to a presenter. So thank you, really, really thank you. And honestly, it's nice to see some familiar faces, folks. So Ellis, there you are. Nice to see you as well. Folks, good luck with busy season. Hope it all goes well. May your tax returns file timely, and may your recoveries always be high. Thanks, everyone. Have a wonderful rest of the day. Bye, everybody.